This is a example of a classic technical chart pattern on Apple stock. This is daily time frame. What you can see is from the later half of 2010 up to early 2011. There was about $100 a share run up in the price of Apple stock. Following that, the stock went into a sideways period, a consolidation gently sloping downward until about the first day of summer. Now, you can see a pretty clear upper boundary these highs tended to respect, and if you double that, you can see a lower boundary of the same angle that also prices tended to respect. Now, this pattern is the flag. It's a bullish flag pattern. Analysts have found, technicians have found that if you measure the flag pole portion and then project it from the low that completes the flag portion of the flag pattern, you get fairly reliable upside targets. 62% is a very good target to use. Is more conservative, and as long as you approach the trade from a somewhat more intelligent point of view than just buying outright, it could be very much a big win, even if it looks like it's not that much price distance relative to this previous flagpole. What we're going to do is examine exactly how you would trade this. So you have your flag pattern. This is a bullish flag pattern, gives you an upside bias, gives you a price target of about 391, 392 area, and the classic way that it's recommended to trade this is on a breakout above the last high during the consolidation. That high was here at 352 area. The breakout occurred on the 6th of July. So once that happens, you have a confirmed pattern breakout and an upside target that is, about $40 away. So that's a very viable trading opportunity. So what we want to do is take a look at a lower time frame. So here's the lower time frame 15-minute picture following the breakout of the bullish flag pattern on the daily chart of Apple. What you can see here is the occurrence of several 4-point patterns. The ABCD, or the dynamic ABCD, is what we're using in this example. The first set of patterns that occurred is good to look at because it shows you the fallibility of the patterns, but also the utility of the patterns. What we're actually looking at here is a case of overlap. You see that this swing right here is the leg or swing CD of the first ABCD pattern, but this swing is also AB, or the first swing of the second ABCD. They're overlapping right here. Well, not knowing that the second pattern was going to plot and only going from this first pattern initially, you may have been a buyer. And what that means is that the method that you use to buy coming off of this pattern comes into question. You can buy using an even third or lower time frame within the 15-minute. You could use point and figure charts. You could use some type of momentum rule. You could use a variety of approaches. It could be a simple percentage movement. There could be many different ways of defining how you enter. That's up to the trader. What we're showing is that depending on how tight of an entry to stop loss you were going for, you may have entered and you may have been stopped out on this first ABCD. However, the second ABCD pattern that occurs did catch the actual pivot. What you can see, it's actually a little bit hard to make out because we're looking at bar charts. Let's switch over to candles to get a bit more information. Now, using the candle chart, you can see that the second ABCD had a D point, or a final point, that coincided with a long lower shadow candle. Now, that type of price action at first glance is indicative of buying, is the belief. Testing will show what the truth is. You can see also this three candle pattern here, where there's selling, support comes in, and then buying. That type of price action, it's not a perfect example of it, but this is a morning star type pattern. And also on this bar, there was a volume spike. Volume was far above the average, recent average. And so when you see a volume spike, this type of price action, it implies buying. And so this ABCD was a much more attractive candidate for entry and for potentially becoming a market pivot, a point from which prices would rise, since this is a bullish pattern, and not return to in the context of this uptrend. And that is in fact what happened. The stop loss would have been fairly wide, waiting for that type of confirmation evidence. You could have been looking at a what do we have here? 348 to 353. So you've got a $5.30 or so stop loss range. If you put the stop loss just beyond the D point, it could have been even wider, depending on how you place your stop losses when you trade off of these patterns. There's many different ways to do it. However, recall that the upside target from the daily is 391 area, and so the reward is clearly the entry to target is still clearly larger than the entry to stop loss, even with the somewhat wider entry to stop loss that may have occurred depending on how you traded this pattern. I'm just showing you what actually happened with the price dynamics. Here we see another ABCD that plotted and also coincided with a low. That's what we're trying to do, is buy low, sell high. This is a way to do that. This is how you can buy low, is by identifying what's likely to be a low. You need to use confirmation that prices are then moving up off of that potential low. You can use a variety of technical tools to do that. Invent your own. There's many things to test out there, obviously. However, this is an important component in buying low into an uptrend. Patterns can help. And so you see with this second pattern, the entry to stop loss was actually smaller, potentially. A $2.71 stop loss if you had a very tight stop loss here. And, put that against a $31.25 run up, you have a very large reward to risk for this particular pattern entry. So that is how we could use this information in the context of a larger pattern with targets and the use of multiple time frames.